Hey everyone, it's the 8th of March at around 5 p.m. and we are Central Time, and we are going to be covering the speed run with 21 different currency pairs for this Sunday afternoon. And we're starting here with the Aussie dollar and CAD, Canadian dollar. And as you can see, over the weekend from Friday around 4 p.m. till now, there has been a surge on this one particular candle. So we moved the stop up to the hump of the dragon in order to protect our profit that as far as the trade that we're currently in. The Aussie dollar Swiss franc, we're looking at one red candle below. We'll confirm this candle at 11 o'clock tonight, but as soon as this candle forms and completes its formation, then we will count this as our first indication to go short. We need another candle to form and also being red before we can have confirmation for this particular short. For the Aussie dollar, Japanese yen, again, same situation. The candle right now this afternoon has been below the RL10, and once it's formed at 11 o'clock tonight, that'll be our first indication if it still remains red at this point. And we will need another additional red candle to confirm, and after that formation at approximately 11 p.m. on Monday night, if it does form at that point, then we will go short for this currency pair. The Aussie New Zealand dollar, it's still wicky. As you can see here, we got up, we got down, we got up, we got down, we got long wicks up going north of the RL10. The RL10's over here, and everything is kind of consolidating with this currency pair. So we'll label this as wicky, and we will not trade it in order to wait for it to actually form a trend that is consistent with the season. Now with this season, it is in the fall, so it's continually go down, but as you can see here, the actual angle has kind of leveled out. So we don't see any actual direction at this point, so there is a lot of uncertainty and consolidation going here before it actually picks a direction. The Aussie US dollar, currently we're in the trade, and we're at approximately break even plus dinner for two. And then if you look at one of the averages for the dragon, we do have a short line. We can move that stop up to this particular point, so in order to protect our profit, right? But as you can see here, it is trying to think out of a direction. It's hitting up some resistance at this average and also at the RL90. But the RL10, there's a convergence of averages, and so it's trying to pick which direction it's going to be going for. The Canadian dollar Swiss franc that we're currently in, we entered in on the 21st of February. We're still in that trade, and we moved the stop down to the belly of the dragon and this location. And right now it's at the extreme end of the Bollinger Band. So what you're seeing is just making sure that you protect and continue to move down that stop in order to protect your profit. Season is winter, and it is matching up nicely, with the overall move. Canadian Japanese yen, we entered in on the 24th of February, and we're still in this trade. And as you can see, could have purchased at the close of February additional lot and gone 2 lots on this. However, with the coronavirus and the uncertainty that's going around, we just go ahead and move our stop from the RL30 down to the belly of the dragon in order to protect our move. So in this case, we're going to go ahead and make sure that we protect that. But what you're starting to see is a widening of this gap, which could indicate a potential snapback later on. The more it gets the distance between the moving averages on the 10 and the 30, it has a tendency to do is snap back. So this is not going to go down forever. It'll eventually either hit zero or some other place along the numbers, but we need to make sure that we keep in mind the distance and the gapping between each one, because this does have a tendency to snap back, and when it does, it'll go back up fast in order to get to the averages right now. And so you see a lot of convergence of the main averages, the 270, the RL90, and the 200. And so once it starts getting away from this, and it also is rubbing up against the extreme edge of the Bollinger Band, when you're at this particular point, there's not much more movement to the downside. The bulls and the bears are fighting pretty hard, and they're going to determine whether or not the trend continues to go downward. We have the Swiss franc and Japanese yen, again very wicky at this point, and as you can see, look, up, down, up, down, up, down, up, down, up, down. And so when it does this, I avoid this currency pair it is, and as you see, a leveling out too of the MACD 1030. But our bias on this particular currency pair, when it does go, is for a short. Just depends on when we have good confirmation of two red candles, solid red candles going down. Euro Aussie dollar, we're still currently in this trade. It looks like the market has had some stops in it at this point, right? So once the market kicks back up there on the Euro Aussie dollar, we'll be able to find out. Sometimes you do get hiccups with the platforms and their connections to the overall currency feeds, and so if the feed is having problems up there, then you'll get what this is called a lockout. And so you got to make sure you watch this as far as a lockout is concerned. But you got the protective stop that's in there, so it should be able to protect it up whether it goes up or down. For Euro Canadian dollar, we have a strong move up all the way up to the extreme end of the Bollinger Band, and so I moved this stop up to the hump of the dragon, right? And what we have now is a continuation of this, and we are protecting our profit as we're going with this move. And we opened this move up on the 21st of February, and we're now in summer. Euro Swiss franc, it again wicky. Even though I have two red candles going downward, these wicks go into this particular area right there. I kind of want to get out of this area before I have any type of confirmation before I move on with a particular trend. Because as you can see here, there's this particular currency can get kind of wicky in certain areas and all that. And so what I want to do is make sure that we have strong candles with a significant red and bold candles without as many wicks up there. That's what I tend to focus on. This currency is in the spring as it is, so this should be an up move, so we should ignore this kind of downtrend unless you want to do a counter trend trade, which I don't recommend with these wicks that are happening with these candles. Again, Euro Japanese yen, same thing. We have a lot of wicks that are happening up there. We don't enter in here because we have one red candle below the RL10. We have a green candle. It goes ahead and nullifies the previous red candle, and we start all over again. Euro New Zealand dollar, we were stopped out at this point. As you can see, it went up against us. So I'm thinking the same thing with the Euro Aussie dollar, that over here, that this is probably up here, even though we don't have any currency feed for that particular pair. So we will wait. This may be the first indication of it going forward. So again, 11 o'clock or 11 p.m. Central Time on Monday may be an indication if we have two green candles for this currency pair that'll allow us to go long. Euro USD, this trade that we entered in on 25 February. And we've moved up the stop to the hump of the dragon. As you can see up there, we have a nice long trend that is skirting the RL10. And so as soon as it continues to move up and up, we move up our stop in order to protect and protect. And we have these wonderful moving averages that help us determine where we should be placing our stop to protect our profit. Again, ruthless risk management. Same thing with the New Zealand Canadian dollar. We had an entry here, the 4th of March, and as you can see, it's moved up and up and up. So I went ahead and moved the stop from down here at the PSAR all the way to the belly of the dragon, then all the way up to the hump of the dragon. I figured that this is a significantly strong move, and and enough to protect our actual trade. So that's break even plus dinner for two. And it is in line with the season. As you can see, it's spring season. So this is all forming up nicely to follow the trend. New Zealand Swiss franc. Again, we don't have confirmation of a particular short. We just have the first candle at about 11 p.m. tonight. I will make the determination as it closes out this candle and forms another candle that we have our first indication of a short. Again, I won't be able to make a confirmation of the trade until 11 o'clock on Monday before I actually go forward with another short. New Zealand Japanese yen, same thing. Candle here, our first indication. First indication confirmation will be at 11 p.m. tonight, and second confirmation, if it is a red candle going downward below the RL10, will be our second confirmation for a short for the New Zealand Japanese yen. New Zealand US dollar, we're currently still in the long, and as you can see here, it's break even plus dinner for two, and it opened up down, and so it's still trying to figure out. And as you can see here, which is kind of interesting, the market went down to take out all those folks that put a stop right underneath this candle. In order to stay in the trade long enough, you want to see these moving averages push, if you're in a long, push the price to the long side. So you have to be patient and wait. So what we've done here is accepted the fact with plus dinner for two, but if your risk tolerance isn't that, and you want to make sure that you protect the profit that you had within the trade, you can move it up to the hump of the dragon. It's totally up to you. But know that you could be your trade could be taken out, and this thing could go further north at that particular time. Right here, break even plus dinner for two to see if there's any potential move towards the upside. But as you can see, is a convergence of not only the RL10 but also with the RL90. So there's a convergence of averages that are going here that could squeeze this price up to pop either up or down. And we don't know where it's going to go, but it could do that. US dollar and the Canadian dollar. As you can see here, we have a trade. We have first green candle is above the RL10. This one is not, so we do not count that. We have another green candle that's above the 10, and then we have the strong move up. And so at this point, we go ahead and with the strong move up, it is on the extreme end of the Bollinger Band. So I want to keep this as a break even plus dinner for two. And it matches the summer season, and it looks like this is what they call a J-hook formation, right? Which is a very strong bullish move for this currency pair. You know, whether or not it continues to go up or down, or if this is just one extreme candle move. But this looks very promising in terms of a continued movement towards the upside. US dollar, Swiss franc. What we have here is a continuation of a short. The 21st of February continues to move down, so I moved it to the belly of the dragon. As you can see here, we're still hugging the extreme end of the Bollinger Band, along with it still being south of the RL10. We will have to make sure that to monitor this gap in case of snapback to the upside. But for right now, we've protected all of this profit, and we're still in the right season. Still winter. Last currency pair was the US dollar, Japanese yen. We're still in this trade. Again, same thing. We entered the trade on the 25th, and we're still in this trade, and it's all been south of the RL10 and continuing to skirt the extreme end of the Bollinger Band. So I moved the stop to the belly of the dragon just to protect all profit that we have in case it does shoot back up. That is the speed run, the spreadsheet in terms of our diary. I added a couple of columns to our diary just to kind of indicate. I mentioned first that we had that one standard lot, which is 100,000 units, which is considered a standard lot. And here is the margin required for my broker. And this is the pip value, up or down, per pip, right? So it goes up 1 pip, it's $7.46. Margin requirement is almost $2,000. But that's for one standard lot. 10,000 units is considered a mini lot, right? And what we do is you just move the decimal place over to as far as the pip value and also the margin required. And this is what they call a micro lot. So you can you can trade micro lots, mini lots, or a standard lot, and all you have to do is move the decimal place over 1 or 2 in this case to determine pip value and margin required. Now I mentioned that the account size is usually 3%, so you can, for one standard lot, if you were to trade this currency, you should have around this amount in order to make sure that you have plenty of money in your account to make this particular trade, right? And if we were to do all of the trades for all 21 currencies, minus the wikis that we are not trading, if we were to trade the wikis too at this point, we would need this much in our account to trade 3% of the margin required. Right, so that's how these numbers kind of pan out. I went over the pip value divided by the margin, and what I did was I went ahead and picked, and it just happened to be 21 pairs. So the higher the number in the percentage equals the higher pip value per margin. Right, so you will be able to get, for every 1 pip, $10.45. And if you have a very low percentage, like say this goes under 20%, for example, like this one is under 20%, you can see here that there's a higher amount for a lower pip value. And I like to tend to stay around 20% or higher, just because there are currency pairs out there that require $13,000 for $1.07, per pip value. And it's just too much margin. It's very expensive margin requirement for me, and I don't tend to like to trade those. Same goes for the British pound. I tend to think the British pound is very expensive in terms of margin requirement versus their pip value, so I don't like trading the British pound. And so for these trades, you have the entry, whether it be short, long, or wiki. In this case, I spelled it all out for everyone. You have your price in, your price out, right, in the trade. Some of these trades are still open, so they'll be the current price that it is listed right now. And as far as the gains are concerned, this is the potential gain, minus any fees, commission, or slippage is what they call. So you have to be careful of the slippage to make sure that you still stay within the trade. You need to monitor it to make sure that your broker is doing the right thing in terms of slippage. If you get a slippage of $100, or in this case, maybe $200, you might want to question that with your particular broker. But most of the time, the slippage is, for this particular pair, for a standard lot, maybe $15, right, or $40, and that's okay. That's brokers buying and selling at a particular time. You think you get a price, and you're just about to get it because it's either a robot that does an automatic trade, or it's a human. And and most of the whole entire market is done by robots or software that automatically closes out a particular trade within seconds. Trillions of dollars is traded every single day on the Forex market. And so this kind of depicts our profit and loss gain. If we were to get out, we get somewhere around that particular amount. Now the reds here are hard losses. So this is a loss that I incurred last week for this particular play, but we're going to continue to follow it, right? So if we either go into a buy or another sell, then we'll see how that pans out. But for right now, these losses are formed, and maybe Monday, like I was saying previously, along with the graphs, we might be able to open up a short trade on one of these currencies. But these 4 currencies are hard losses. All right, so for the green codes, like some of them, break even plus dinner for 2. In this case, this was a long, right? That's a nice dinner. This is what we're currently at in terms of price, and then I'll have a price out, but I do have a stop to make sure that I have that protected. and it goes for the same currencies as I go to the belly of the dragon on each one of those. All right, but this is the current price for each one of these, and once these close out, then we'll start over with another trade. But not bad since the end of February till now. And as you get up your total gains, if you had traded all 21 currencies, this is your total gain for this point. And for the mini lots, this would be your total gain from the 21st on, and this is your total gain from the micro lots. Micro lot gains, as you can see, are much smaller, but you're not risking as much margin on this because you move this over. Right, for example, this was $11 gain. Move this over, you're only risking a margin required of $19 in your account. Now I've seen micro and mini lot accounts opened up for $50, sometimes $200. It just depends on your broker. Make sure that you are comfortable with that particular risk. Practice what the system that you use. I currently use the Dr. Ken Long's regression line Bollinger Band method. His system has been pretty successful for my trading. Okay, that's all I have for you today. What I'm going to do is I'm going to open up another video at about 11 o'clock tonight to do the closeout of this candle. Happy trading, everybody.